I was wishing I had put a cartoon in the presentation, so I'll tell you what I would have put had I thought to put the cartoon. There's a New Yorker cartoon about a year ago. Two bankers sitting in an office, one of them saying to the other, "These new regulations are going to fundamentally change the way we get around them." And so it's apropos. So I am going to talk about contingent capital. For those of you who haven't followed the contingent capital discussions closely, I'll explain in more detail in a few minutes exactly what I mean by contingent capital. But basically, it's going to be equity that appears in times of distress. And this sort of my motivation for writing this paper originally was thinking about this as sort of a financial engineering problem. The question was, it seemed like contingent capital was something that was likely to happen. It was mentioned in both the House and Senate bills as something that the regulators are going to be encouraged to look into and try to enact. And so, and there were various proposals floating around, and so I wanted to think about what the issues actually were in structuring a claim like this. And it's there are actually a lot of issues that come up when you think hard about what a contingent capital claim actually would consist of. I'm going to actually echo, this first slide is going to echo some of the things that Gene was just saying. So I think of there being sort of two classes of problems that were evident during the crisis. One was what you might call synchronicity, which is that you had a lot of financial institutions all doing the same thing at the same time. And that's common to many financial crises. And then the other was you had these interconnections, which one institution failing could potentially cause a domino effect of other institutions failing. And that's not necessarily the same thing as synchronicity. You could have banks betting against each other. One fails, and that brings down the one that was betting against it because of credit risk. So they're different things. And what the contingent capital proposal I'm going to describe is really about is dealing with synchronicity. So the idea is really sort of to provide a buffer, a little bit of, buy some time in the event that you have a bunch of financial institutions that are sort of going down together. That's the sort of the point of the proposal. So first thing to keep in mind, and I think this is obvious, is that there are just simply no simple solutions to the problems and the financial issues that have come up. So, the proposals include restricting bank size, restricting bank activity, increasing capital requirements, mandating central clearing, systemic risk regulation, living wills and resolution authority, contingent capital. I think it's obvious when you look at that list, contingent capital is one piece of that. It's not a panacea. It's not going to really do more than just, potentially address one thing, and as I said, I think what it'll potentially do is provide a buffer in times of crisis. The thing to keep in mind about contingent capital as we talk about it is this is not a claim that firms issue by themselves. So you don't see firms issuing bonds that convert into stock. You just don't see firms voluntarily issuing those kinds of claims. So that suggests that maybe there are some issues associated with them, and so that's just something to keep in mind as we go through this. So let me explain what contingent capital is. So contingent capital generically is going to be a claim that converts into equity or that somehow provides resources to an institution in circumstances in which the institution is ailing. And so there are a lot of ways to structure a claim like that. Examples, there are actually two prominent examples now. Lloyd's Bank has issued a reverse convertible bond, which is a contingent capital bond, which basically, when their regulatory capital ratio falls below 5%, this bond converts into equity. Rabobank recently issued bonds that basically, if their regulatory capital falls below 5%, 75% of the bond goes away. So it basically just, they pay out 25% of the bond. And Rabobank had to adopt this kind of structure because they don't have shareholders. They're a mutual. So they couldn't have done the Lloyd's kind of contingent capital. And then there are proposals, for example, DeMarzo and Duffy have a proposal for rights issues. So there are a variety of possible structures. What I'm proposing is is contingent capital that, and what this paper is about is contingent capital that does, that has two conditions for it to trigger. One is that the firm's stock price falls sufficiently, and the other is that a market index falls sufficiently, so something like a financial firm's index. And the reason for the financial firm's index to fall, so this is sort of echoing what Gene was saying a few minutes ago. Basically, if you think bankruptcy is valuable, then you don't necessarily want to prevent firms from going bankrupt. And we know they voluntarily adopt fragile capital structures. That's a point that's popped up in the academic literature. But the idea would be that so if a bank is uniquely bad, it fails. But if a bank is systemically bad, so that all banks are failing at the same time, the idea would be to potentially buy some time with contingent capital. And as I mentioned, both the House and Senate reform bills call for contingent capital enactment. So what is a reverse convertible? So just to sort of illustrate this, this is just a generic picture of what a reverse convertible looks like. But the idea is there's some underlying asset, and if the price of the underlying asset is high, you get paid a fixed amount. If the price of the underlying asset is low, you participate in the underlying asset. So an ordinary convertible bond pays you a flat amount in bad times and a variable amount in good times. This pays you a variable amount in bad times. And hundreds of these things have been issued, but they've generally been issued, these reverse convertible structures have generally been issued on third-party claims. So, you can buy reverse convertibles that pay you based on the oil price, for example. Firms don't seem to issue these based on their own stock price. So there are two leading contingent capital proposals that have gotten a lot of discussion. One of them is Flannery's contingent capital proposal. Let me say Flannery was really the first person to talk about this in a serious way that I'm aware of. So Mark's proposal basically was the idea that you would have systemically important banks would issue these contingent capital certificates that would convert into stock when their capital measured as a ratio of their stock value to their assets fell below some trigger amount. And the idea of, for example, if the market value of equity to assets fell below 4%, you would convert just enough of these contingent capital bonds into stock in order to bring it back up to 4%. So you would maintain a sort of a minimum level of capital measured as a market value. And the Flannery proposal was I think, a little bit controversial because nobody was quite sure how this trigger was going to work. One of the things I'll discuss later is the fact that it relies on accounting measures, I think, is problematic. It's sort of a low-frequency device in the sense that, accounting measures are released quarterly, and you might need something that triggers very fast. And so the Flannery proposal might have that problem. And one of Mark's issues was he really wanted something that addressed the too big to fail problem. So he really had the idea that this was for big banks, systemically important banks. They would issue these claims, and the idea would be to basically prevent them, if possible, from failing. Okay. Another leading proposal was the Swan Lake Group contingent capital proposal. And I think there actually may be different versions of this floating around. The one I've seen basically required two things to happen in order for the contingent capital to convert. One thing that had to happen was that banks would issue these claims, and then regulators would have to declare that there was a financial crisis in order for these to convert. And then the other is that the specific institution would have to violate covenants. So, you would have some kind of covenant written in terms, for example, possibly of market value of your equity to assets, something like the Flannery proposal. But the key thing was that regulators would have to declare a systemic crisis in order for these to convert. And a couple reactions to that. One is that it seems I don't know how many people would want to be the regulator who had to stand up and say we have a systemic crisis. That seems like a tough position to be in. So at any rate, the the other thing about this proposal is I think the reason they had this regulatory trigger is that for example, Diamond and Rajan have written papers arguing that financial fragility is a key part of bank structure. That in order for banks to operate the way to fulfill the economic function we want them to fulfill, they need to be financially fragile. That they have to issue claims that are subject to runs and so forth. So I think the reason for the Squam Lake proposal to be framed in this way was in order to have in order to allow financial fragility except in times of distress. But that may or may not be correct. I think I saw Chester shaking his head no back there. So I don't know. Anyway, okay, so when you think about where a contingent capital claim would fit in capital structure, currently there are rules that specify Tier 1 and Tier 2 capital requirements. So think of Tier 1 as common stock. Think of Tier 2 as subordinated debt. It's always struck me as strange that a debt claim would sort of serve as capital. And the thing is that what Tier 2 capital does is it protects senior debtors against failure. It doesn't protect the bank against distress. And so I think one thing people are talking about with contingent capital is that the idea would be it would replace subordinated debt. So you'd have a claim that would be an equity buffer that would not trigger, if it were triggered, it wouldn't trigger failure of the bank. There are other possibilities here. So contingent capital is one thing people have been talking about. You could also just say, well, firms ought to issue more common stock. Maybe they should just issue preferred stock. It's not necessarily clear why contingent capital per se is optimal. So when you think about how to structure a contingent capital claim, think about the issues you need to deal with. There are questions like what percentage of the bank ought to be financed with contingent capital. And as I said, I think a natural thing to do would simply be to replace Tier 2 capital with contingent capital if you're going to do something. The question of how a conversion trigger ought to be designed, we've seen the Flannery proposal, Squam Lake, and I'm discussing something different. Does contingent capital protect primarily against systemic events, or is it protecting against too big to fail institutions? What exactly is it doing? How important is it that it convert quickly? I think Lehman, obviously there's going to be disputes about the lessons from Lehman, but I think Lehman suggests that things happen very fast. And so if you are going to have something like a contingent capital in place, you presumably want to have the possibility of speedy conversion. And then question, what does it convert into when it converts? You could imagine converting into preferred stock, common stock, or just something like debt that just goes away, like the Rabobank. So the goals of the specific claim I'm going to talk about. The claim I'm going to discuss the proposal was that it would convert in the event that the stock price fell and that a financial index fell. And the goals would be to provide for conversion first if there's a systemic event. That would be the index trigger portion of this. Secondly, the idea would be to preserve the incentive effects of debt. So if you have a uniquely bad bank, it would still be permitted to fail because the claim would not trigger. There would be no need for regulators to pronounce a crisis. Allow the market to say there's a crisis. Now, of course, we all know the stock market. There's the famous line about predicting 9 of the last 5 recessions due to Paul Samuelson. The market's not perfect, but the idea would be that to rely on the market rather than rely on regulators. This would avoid reliance on accounting numbers. One of the things that happened during the crisis was we saw that accounting rules got changed in response to events during the crisis. The idea would be to allow conversion to occur quickly. And then the goal also would be to design it in such a way that it wouldn't be manipulable. So the claim would not, that market manipulation of the stock would not necessarily be used to trigger the claim. And I'll say more about that. So I think the idea at a minimum, you would have contingent capital replacing some debt to provide a buffer during times of stress. Okay, so questions that are in the background that I'm not really going to be able to answer. How do you think about the economic role of contingent capital, apart from the idea that you're providing a systemic buffer from the specific, sort of design I'm talking about? It's the question of what role a structure like this plays, I think, is open. In the background is what is the optimal bank capital structure? How do you think about that? And where's the Modigliani-Miller theorem in all this? So, how should we be thinking about bank financing overall? And your views about things like the Modigliani-Miller theorem and whether it applies to banks are going to affect your decision about what kinds of reforms to enact. Yeah. Yeah. Well, I think there's. So I would say there's two. I think of there being. I think of there being a big question, and I think of there being a smaller question. So the big question is, how do we think about bank capital structure? I don't think we have an answer to that, and I don't think we're going to have an answer to that in the near future. It seemed to me likely that there would be contingent capital proposals enacted of some sort, and so it seemed to me useful to think through the issues associated with contingent capital. So I think so what I think of as the economic, just to go to the first bullet point, what I think of as the economic function you could argue contingent capital serves is if you have a systemic event that you provide a buffer for financial institutions. And the idea, because systemic events are sort of associated with externalities, they're not things that are well captured by individual bank contracting, and so that would be the argument. Go ahead. So that's an interest. Well, yeah. So my view on that is, so I was always skeptical of the idea that contingent capital would get debt treatment. I've heard tax people say it wouldn't. It would not in current incarnations. Right, and so but at the same time, if this is something that's important, there's no reason you can't enact a special rule to give it debt treatment. There's no reason Congress can't do something about that if it's deemed important. So.
But if you do that, why not make bank dividends?
That's a different answer than I heard when I pressed Mark Flannery last week. Actually, he had the opposite answer, which was, well, the tax issues were so complicated that we couldn't deal with those issues. Which was the opposite answer.
Oh no! Well, so I think I don't see any the same. So there was a conference at the New York Fed a month ago, or a couple of weeks ago, talking about contingent capital, and the banker there who talked about it had the same thought I did, which is that there's no reason that you couldn't have a special rule for this kind of security to give it tax deductibility if that's really critical. But okay, so let me explain sort of how this contingent capital. Just to explain the structure a little bit. So imagine you have a bond that pays $1,000 at maturity if it hasn't converted. Conversion will occur when the stock price reaches $50. You can sort of create a taxonomy of claims where you could convert into a fixed number of shares. You could simply pre-specify the number of shares into which the claim converts. I call it a fixed share conversion. You could pre-specify the number of dollars you get. Call that a fixed dollar conversion. You could, if you have a $1,000 bond, you could convert into $1,000 worth of stock. That's a par conversion. You could convert in principle, convert into stock worth less than the bonds, or you could convert into stock worth more than the bonds. And it turns out not all these structures are really feasible. So there's a paper by Sundaresan and Wang that basically shows that if you use a stock price trigger, you basically have to convert into an equal value of bonds. So if you have $1,000 worth of bonds, you have to convert into $1,000 worth of stock. And this basically means that in terms of the taxonomy, you basically have to have a fixed dollar par conversion. That's basically that's the form of convertibility that'll avoid the multiple equilibrium problem they talk about. They have an example where if you sort of convert into an arbitrary value, you have multiple equilibria. The stock can be different prices depending on what you assume it is. So the idea of the dual trigger, so the dual trigger adds an index trigger to this claim. And the idea would be that you need both triggers satisfied in order for the bond to convert. So if the index trigger is breached first, then the bond would convert into shares when the stock hits whatever the trigger price is. So for example, you could say when the stock hits $50, you get 20 shares. And if the stock trigger is breached first, the bond converts when the index trigger is breached. And I think probably the simplest kind of structure would be you'd simply, once one of these triggers is reached, it's permanent, and then the other trigger sort of becomes the dominant trigger. Okay, so the design of these triggers can potentially be quite complicated because you would need to be thinking about, you wouldn't want to just have something that triggered the minute a trade was struck at a given price. That would be far too easy to manipulate. So typically for things like barrier options, you have triggers based on multi-hour averages or multi-day averages, and presumably something like that would make sense in this context. And basically you want, but the idea is to have triggers based on average prices in order to avoid extreme sensitivity to single prices. Okay. So and then there's a question what the level of the stock trigger is. If you could have a high stock price trigger that creates frequent conversion, a low stock price trigger that makes for infrequent conversion, and when conversion then occurs, you would potentially have big changes of ownership because you'd have a lot of stock being created. But at the same time, if a shareholder is concerned about, one of the things people talk about is dilution, a shareholder concerned about their ownership being diluted can simply hold a pro rata share of whatever the contingent claim is. So there's no reason that you necessarily have ownership changes when these things get triggered. So I want to talk a little about manipulation because I think this is something that a lot of people have discussed in this context. Generally, when lay people talk about manipulation, they talk about somebody shorting the stock, driving the price down, and then buying more and making money on the way back. And academics don't think that's a feasible strategy. But it can be a feasible strategy if you own an additional claim, like a derivative on the stock. So if you could do something to temporarily manipulate the stock price down and then back. So say that's a zero net present value activity. But if you own a bond that converts based on the stock having been manipulated, then you can potentially make money. And there's some evidence that this happens in the option markets. There's a paper by Pottishman and G that sort of talks about expiration day effects, and there's some evidence that there's manipulation by option sellers. So you want to be thinking about what the possibility of manipulation is, and I'll say something about that in a minute. And then there are other manipulation possibilities. People have worried about the existing stockholders somehow forcing conversion, although I don't think that makes sense in this case. There may be, if you have an index trigger, you might worry about index manipulation, although that seems very hard to do. It may be possible to manipulate the bankruptcy process. I'll say something about that. And the firm people have talked about manipulating the price by repurchasing shares. Again, that seems unlikely to be a long-term successful manipulation. Just to indicate why I'm talking about manipulation, suppose that you have a stock price of $51 and a trigger at 50, and the bond is going to convert into 20 shares at a stock price of 50. If you could somehow manipulate the price down from 51 to 49.99 and then back up to 51, you'd make an immediate 2% gain, right? So if you own the bond. So the point is that the bondholder could, if they could do something in the stock, they could affect their gain in the bond. It's worse. Now in that manipulation, it doesn't matter how far down you manipulate it, you're still going to get your 2% return. What matters is the price it comes back to when you finish when you're done with your manipulation. If you had a fixed dollar if you have a fixed dollar conversion, then what happens is you're going to get a fixed dollar value of shares. So the farther down you manipulate the price, the more shares you get. And when the stock comes back, you're going to have an even bigger, you're going to have an even more valuable position. So in this example, if the stock's $51, if you could manipulate it to 45 and convert it there, and the stock comes back to 51, you make a 13% return. So with a fixed dollar conversion, what matters is the difference between the price you end up with and the price you manipulate it down to. So potentially, you would worry about a fixed dollar conversion because there's this manipulation possibility. And as we've seen, the Sundaresan-Wang result basically says you have to have a fixed dollar conversion for it to be a robust.
Sundaresan-Wang result relates to a case where you've got just the price of that claim, not where the claim's value depends on an index. Is that correct?
Yes. So this is a case. So think about. Right. So the thing is, you need both triggers to be satisfied. Right. No. So the Sundaresan-Wang. So what they show is that if you convert into $1,000 worth of stock, then that's fine. That's a sustainable claim. That gives you a unique equilibrium. And with the situation I'm talking about here, the index trigger would already have to have been satisfied. So for this, and then you're in the Sundaresan-Wang world. If the stock trigger is satisfied first, then you're out of the Sundaresan-Wang world because then everything depends upon what happens to the index trigger. So this would be an index trigger is already satisfied. Now we're just talking about the stock trigger. Okay. So that's why their result is important here. Okay. Okay, and so as I was saying, there's a conflict between minimizing manipulability and the requirement for fixed dollar conversion. So potentially, you could also imagine index manipulation, and I don't think that doesn't seem very likely, but it's something that you would want to keep in mind as a possibility. An interesting possibility is bankruptcy manipulation. Manipulation of the bankruptcy process. If you had a situation where the value of the shares into which you would convert would be less than what you would potentially get if as a recovery for the bond, because it's a bond until it converts. And if you had a situation where the stock would be worthless but the bond would be worth more, then you could imagine attempts by bondholders to try to manipulate the bankruptcy process. For example, there are ways you can gain control of the shares and potentially affect the behavior of the firm. This is there's the empty voting, empty creditor, these kinds of problems that people have talked about recently. Well, I think you want it to be. I've been thinking of it as junior debt. Let me think about that. So accounting. Here I just mentioned some of the reasons you don't necessarily want to use an accounting-based measure to trigger something. Well, as I mentioned before, accounting's done periodically. It's subject to political pressure. We saw the FASB retract their ruling on 157 on fair value. Accounting rules are subject to arbitrage. For example, we saw Lehman and other large institutions. We know they window dress their leverage. Accounting measures often backward-looking. So generally speaking, accounting seems problematic. There's a question of what happens when you enact a program like this. Do you hurt the price of the stock of the institution where you say you're now required to issue contingent capital? And I won't go, because of time, I won't go through this, but I will just mention the class of institution for which this would take the biggest hit here is the too big to fail institution, because that's the institution that basically has a perpetual annuity from the right to issue debt at too low an interest rate. And if you make that debt less safe, then you're basically going to they're going to take a permanent hit to their stock price, whereas all the other claimants, anybody not too big to fail, is not going to take as big a hit. And then just sort of, in thinking about this, I think it's just important to think about the errors you make when you have any kind of policy really, but in contingent capital, you want to think about whether you're converting. How likely are you to convert when it's not necessary? How likely are you to convert when necessary, or failing to convert when necessary? And I think what I'm calling the type 2 error seems a lot more serious. That you can imagine problems with market closures, prices failing to fall because they expect the government to come in and rescue the firm, regulatory triggers, if you have a regulatory trigger, the government not taking prompt action. So there are a variety of reasons with some of the proposals that the bonds might not convert when necessary. And then type 1 errors raise the question of excess capital. So the tax deduction issue, which Chester mentioned, is one. And Diamond and Rajan, I think, would point to insufficient incentives if you have too much capital. So there's this balancing of type 1 and type 2 errors. And I think the market triggers are fall on the side of giving excess capital rather than too little capital. Okay, and then I think I'm pretty much out of time. So let me just conclude by saying contingent capital. I don't think it seems like part of a financial reform. It seems like it has the potential to address the one issue of what if you have a bunch of synchronized banks all failing together. It seems like it has the potential to buy regulators time in that case. And but any design entails trade-offs, and I've tried to articulate a lot of the trade-offs in this paper. And I think pure market triggers have the advantage of being immune to political pressure. They will err on the side of triggering too often, which may be a feature, may be a bug, and the disadvantage of potentially being manipulable. So thanks.